neutral party who legally conveys Welcome to our first trust training session. This is the first in a series of 5 training sessions that are designed to help you learn how to understand and use your new Spendthrift Trust. In this session, we will be looking at the various roles involved in a Spendthrift Trust, how to open a trust checking and credit card account, what assets can go into the trust, and how you move them into it. We will also be discussing how to transfer insurance, notes payable, as well as leases into the trust. Let's begin by understanding the basic roles played by the various parties involved in a Spendthrift Trust. There is a settlor, a trustee or trustees, a compliance overseer, and beneficiaries in the trust. Who are they and what does each do? The settlor or grantor is a neutral party who legally conveys or transfers the trust from the law firm to the trustee and then permanently steps out of the picture. It must be someone who is not connected to the trust as a trustee, compliance overseer, trust guardian, or a beneficiary, or ever will be. The trustee is the legal fiduciary of trust assets and is charged with running the day-to-day business of the trust. He holds and administers trust property and assets, pays all trust bills, files trust taxes, and distributes the assets according to the terms of the trust, all for the benefit of the beneficiaries of the trust. The trustee cannot be a beneficiary. The trustee also performs all trust actions as directed by the compliance overseer, trust guardian, or trust protector. The compliance overseer, trust guardian, also known as trust protector, has the supreme authority over the trust. He or she determines how the trust operates, appoints trustees, and can appoint or remove beneficiaries at will. The compliance overseer, or trust guardian, cannot be a beneficiary. The compliance overseer is the guardian, manager, and overseer of the trust and its assets. The beneficiaries of the trust are those individuals or entities who will receive the benefits from the trust. They can be added or removed by the trustee or compliance overseer at will. Next, let us consider where and how to open a trust checking, savings, and credit card account. To open an account, the trustee takes the trust EIN issued by the IRS, the trust document, the trustee state ID card, and goes to a bank familiar with trust accounts. Wells Fargo is one financial institution that does. The trustee then opens a trust checking account and perhaps also a savings account to begin paying for trust expenses. Regarding credit cards, most banks will not open a credit card account for a trust since there is no person to come after to collect indebtedness, only an entity. As a workaround, however, the trustee may open a personal line of credit on a credit card. Once issued, the trustee simply writes trust in indelible ink with big block letters across the top of the card. Henceforth, that card should only be used for trust business and not personal charges. It's that simple. So what assets can go into the trust? Everything. Residence, land and buildings, vehicles, household furniture and fixtures right down to the pictures on the wall and the silverware in the drawer, guns, jewelry, precious metals, stocks and bonds, as well as other investments. Since moving assets is the biggest step you will take in setting up your new Spendthrift Trust, we want to cover some important aspects to help you. How do you move assets to your trust? Land and buildings. Assets including your home can be sold to the trust. A notarized bill of sale, personal residence, with a warranty deed will move your personal residence into the trust. Independent Financial Services is able to provide you with a template of this form. This bill of sale personal residence includes a statement that most all states' property taxing authorities will accept for you to be able to maintain your homestead exemptions and any other exemptions, over 65, vet, etc. IFS recommends that a warranty deed be used to sell real property, for example, personal residence, land, and buildings, to your trust, and we also recommend you seek assistance from a real estate attorney to accomplish this. Your home is the most prized possession, and so using an attorney is advised, though it is not required. For land and buildings that are not a part of your personal residence, use a notarized bill of sale, land and buildings form with a warranty deed for each building and each separate owned piece of land that is not on a deed with the building or structure. IFS is able to provide you with a template of this form. Here are some basic considerations to keep in mind. The seller or sellers is the person or persons listed on the original recorded warranty deed. If two sellers, be sure to list both names in the space provided. The buyer is the trust. The trustee signs for the trust. In the property legal description, list the property exactly as it is recorded on the warranty deed. Attach a copy of the original recorded deed. Each seller and buyer signs, and a notary is required for each signature. Keep the signed copy with your trust documents. You can have the completed warranty deed recorded at the courthouse if you wish, but there is no requirement that this be done. Before recording, check with your property taxing authority on the property tax effect of transferring the property into the trust. Also check with your homeowner's insurance company on how recording might affect your insurance rates. The value of the sale on any land and buildings, except your personal residence, is sold to the trust at your cost basis, plus any improvements, less any depreciation taken on buildings. Your personal residence is sold to the trust at fair market value or as close to fair market value that does not exceed the capital gains inclusion amount. The appraised value shown on your last property tax bill can be used to determine the sale amount. How to transfer motor vehicles into the trust. Use the bill of sale for motor vehicles form for each vehicle being sold to the trust. Independent Financial Services is able to provide you with the template of this form. Seller is the person or persons listed on the title of the vehicle. Each seller and trustee signs at the bottom. A notary then notarizes each signature. Keep the signed copy with the trust documents. You can have the title of the vehicle changed at your local DMV if you wish, but there is no requirement that this be done. Before changing the title, check with your insurance company to determine if changing the registration to the trust might affect your insurance rates. The sale price for the vehicle will be your cost basis in the vehicle, not the current market value. Other property and assets. Use the notarized bill of sale, general, for all other property and assets you sell to the trust. Independent Financial Services can provide you with a template of this form. Use as many forms as needed. The bill of sale will require notarization of each signature. List the property and assets on the lines provided, or if there are more assets than what will fit in the space provided, write See attached Exhibit A. You can sell all of your property and assets. Example, household furniture and fixtures, campers, lawnmowers, tools, equipment, etc. Usually, household furnishings can all be lumped together as household furniture and fixtures, and the value will be the value shown on your homeowner's insurance policy for furnishings and fixtures, usually about 25% of the insured value of the home. How to transfer insurance into the trust. Use a separate form to transfer your investments and insurance policies. Use the notarized bill of sale, general. Independent Financial Services can provide you with a template of this form. Have the ownership and beneficiary for each changed over to the trust. The seller or sellers are the original owner or owners of the property or policy, and the buyer is the trust. The seller and trustee sign each form at the bottom and also have your signatures notarized. Keep these forms with your trust documents. How to transfer notes payable and other liabilities to the trust. Use the trust assignment of note form to transfer each of your mortgages and other liabilities, like notes payable, to the trust. Independent Financial Services can provide you with a template of this form. You will probably have to keep yourself as guarantor of the notes, but the trust can hold the note and make the principal and interest payments. The original note holder is the debt instrument holder, the person holding the original note. Be sure to attach a copy of the original note to the assignment form. The trustee and the note holder sign, and both signatures are notarized. Leases transferred to the trust. Use the trust assignment of lease form to transfer each of your leases, like vehicles and apartments. Independent Financial Services can provide you with a template of this form. You will probably have to keep yourself as the guarantor of the lease, but the trust can hold the lease and make the lease payments. Leaseholder is the lessor, the one leasing the property to the trust. 2 is the lessee, the trust assuming the lease. Be sure to attach a copy of the original lease to the assignment of lease form. The trustee and the original holder of the property sign the form and have both signatures notarized. The information we covered in this session may seem like a lot, and it is, but you have taken the first step into a new and larger world, the world of the Spendthrift Trust. It is a step that thousands have taken before you, which will help protect your assets and build generational wealth. Congratulations. Thank you for your attention to this training video. In our second instructional video, we will teach you how to use the purchase of assets and liabilities spreadsheet for managing your trust. See you on the next video. Welcome back to our trust training with session number 2. In the first video, we discussed the role of the settlor, trustee, trust guardian, compliance officer, and beneficiaries. We also explained how to open a trust checking account and a trust credit card, what assets can go into the trust, and how to get those assets into the trust. In this session, we are going to teach you how to use a purchase of asset and liabilities worksheet for your new trust. How to use an Excel assets and liabilities worksheet. The purchase of assets and liabilities MS Excel worksheet is designed to keep track of assets and liabilities, or notes, purchased by the trust in which a demand note is used for payment. This is a key component to keeping track of your trust, so we are dedicating this whole second video to it. Most accountants will be delighted if you use an MS Excel format, and Independent Financial Services requires it. When sending IFS the completed worksheet from other than a Microsoft Excel format, export the worksheet to Excel prior to sending it. OpenOffice is a free program that will import-export Excel worksheets. Mac Numbers also has a worksheet that imports-exports MS Excel sheets. Do not use the assets and liabilities worksheet for assets purchased with trust cash. Cash purchases should be recorded on the deposit and expense register worksheet, which will be covered in the next video. Assets purchased by the trust using the trust bank account are to be posted on the deposit expense register. Record all assets, not cash, purchased from a trustee or beneficiary by your trust where the trust bank account was not used. Be sure to record any notes or liabilities against the asset. The trustee uses the purchase of assets and liabilities worksheet to record assets and liabilities sold to the trust from a trustee or beneficiary. Assets and liabilities may include, but are not limited to, real estate, vehicles, stocks, or other securities. If held in a brokerage account, it is sufficient to use the brokerage name and account number as the description. Currencies or other cash value instruments not put in the bank account businesses, equity and limited partnerships, furniture, fixtures and equipment, precious metals, works of art, business intangibles such as goodwill, copyrights, patents, instructional manuals, computer programs, etc., other valuable assets transferred to the trust, notes payable to include mortgages and vehicle notes, and other liabilities transferred to the trust. Let's talk about how to fill out and accurately record all of your trust transactions. Start by inputting the trust name at the top to the left. Each time you update the Purchase of Assets and Liabilities worksheet, replace the as of date with the current date. The Purchase of Assets and Liabilities worksheet is a 5-column electronic form. Here is how to complete each column. For each asset and liability, do the following. In column A, record the description of the asset or liability. In column B, record the date of the asset sold to the trust, not the original purchase date. In column C, record the chart of account number that identifies the financial group number for the asset or liability. A chart of accounts is available on the IFS website. In column D, record the cost basis or book value in the asset value column. Cost basis is what the asset cost plus improvements of land and buildings or book value cost less depreciation if depreciation was taken for business assets. Do not use fair market value except for sale of your personal residence to the trust. All sales are based on contract law, and legal sale contract documents, i.e. a bill of sale, must be drawn up and be notarized. In column E, record the liability, which is what the balance is on the date it was sold to the trust, in the liability value column. Include any notes on your home, vehicles, or other assets. In column G, record the name of the trustee or beneficiary who sold the asset to the trust so that credit on the end-of-year demand notes can be accurate. Here is an example. To explain this chart, note that the land investment is posted at its cost basis. The vehicle is posted at its cost basis and is owned 100% by the trustee. If owned jointly, half the value would be posted to each owner. The vehicle has an outstanding note and is posted at its note balance on the date sold to the trust. Again, if the vehicle was jointly owned, the note balance would be posted to each individual house where its land is owned jointly and is posted at its cost plus improvements plus closing cost when purchased plus an amount to take it to fair market value without exceeding the capital gain exclusion. The house note, like the vehicle note, is sold to the trust at its payoff balance as the date sold to the trust and is also owned jointly. Household goods, such as furniture, fixtures, and other possessions, are sold to the trust at the amount covered by the homeowner's insurance policy. Tools are sold to the trust on estimated cost basis. Life insurance is sold to the trust at the cash value as of the date of sale to the trust. Brokerage accounts are sold to the trust at the account balance as of the date of sale to the trust. So for review, the Purchase of Assets and Liabilities worksheet is used only for personal assets and liabilities initially sold to the trust. Do not include assets the trust purchases. These will be shown on the deposit expense register because they would have been purchased with trust dollars or credited as trust purchases, as well as reimbursements to personal. List a brief description, date sold into the trust, the book value or cost basis, remembering personal residents are to be listed at or close to fair market value, as well as list the trustee or beneficiary who transferred the asset into the trust. For property jointly owned, list the portion owned by each on separate lines. Do not include dollars you transfer or deposit into the trust. These are recorded directly on the deposit expense register. The Purchase of Assets and Liabilities worksheet is used to establish your demand note and provide independent financial services the information needed to set up and maintain your trust financials. Update this worksheet each year as you sell personal assets into the trust and provide independent financial services a copy so they can maintain an accurate asset and liability listing for your trust. Thank you for your attention to this training session. In our next instructional video, we will teach you how to understand trust income, trust expenses, as well as how to use a deposit expense register and a chart of accounts. The information we covered in this session may seem like a lot, and it is, but you have taken another big step into the world of the Spendthrift Trust. Thank you for your time and attention to this second training video, and we will see you on the next one. Welcome back to our trust training with session number 3. In the second training session, we discussed how to transfer insurance into the trust, how to transfer notes payable and your liabilities into the trust, transferring leases to the trust, and how to use an Excel asset and liabilities form. We want to continue with the topic of understanding trust income and trust expenses and how to use a deposit expense register. So let's begin with understanding trust income and tax deferral. First of all, business and farm income should be kept separate and not be deposited into a beneficial trust. A business trust or other outside organization, such as a corporation, LLC, Schedule C, or Schedule F, is used for this pass-through income. Business and farm income should be passed through to the operator of the business and taxes must be paid. If you are using an outside business such as an LLC, S-Corp, sole proprietor, the IFS website has instructions and forms available to help you use an outside business organization in conjunction with your beneficial trust to assist you in reducing taxable income. Trust income that qualifies for tax deferment under IRS Code Section 643 is interest, dividends, capital gains, rents, royalties, and other investment income reported on Schedule E or K-1s that is not business income or active income. Income meeting IRS Code Section 643 is deferred by declaring it as extraordinary dividends. These extraordinary dividends are held in the corpus or equity of the trust until distributed to a beneficiary, at which time taxes are due. Now, the next thing to understand is what constitutes legitimate trust expenses. Understanding trust expenses. People with trusts will want the trust to pay for every expense they can. However, the trust must own the asset or liability to be able to pay for the expenses related to that asset or liability. So you must transfer the ownership of the asset or liability to the trust via a bill of sale before the trust can make expense payments related to that asset or liability. Use the chart of accounts that IFS furnishes on its website for the categories of expenses. All expense payments must be made to the third party or receiving party, not to the trustee or beneficiary. Reimbursements for authorized trust expenses paid by a trustee or beneficiary must have the receipt for the expenses provided to the trust before the trustee or beneficiary can receive the reimbursement. How to use a deposit expense register. The Deposit and Expense Register worksheet is provided so that you can keep track of trust income and expense transactions on a contemporaneous basis. The register is like the check register you might use for your bank account. The register should match your trust check register and the trust bank account and be reconciled each month. It is critical that your beneficial trust financial data or deposit expense register Be kept up to date on a monthly basis, so after receipt of the Trust's December bank statement, a reconciliation can be completed in the first week of January, and then the completed data can be sent to an IFS accountant by January 20th. Here are the basic instructions to keep an accurate record of trust transactions. Use a deposit and expense register, which IFS has available on its website in an Excel template format. Save the original and give it the name Deposit and Expense Register Master to have on your computer to use for the following years, as well as if you need additional space. Make a copy of the Deposit and Expense Register Excel file and give it the name Deposit Expense Register YYYY Account, where YYYY is the year and account is the last 4 digits of the bank account or credit card number. Open the copy of the register you just made. Input the trust name at the top. After the trust name, please indicate which account this register is being used for. Example, XYZ Trust / main checking account. The starting balance should be 0 for the first year. After the first year, enter the bank balance as of December 31st of the prior year into the starting balance block. If using additional sheets, be sure to enter the ending balance for the prior sheet as the starting balance on the follow-on sheet. Use a separate deposit and expense register for each bank account, savings account, and rental property, just as you would use a separate check register for your checking and savings accounts. Each year, begin a new register for each account to make record keeping easier. When you set up a new register next year, you will look at the year ending balance and type that amount into the Enter Starting Balance box on the New Year's register. For each transaction, input the date of the transaction in the date column. Give a brief description of the transaction. For deposits, you may write the source of the money being deposited. For expenses, you may write the name of the payee category, or simply enter the category such as supplies, medical, repairs, etc. Look at the chart of accounts, which will be discussed in a few minutes, to determine which account most accurately reflects the nature of this transaction. The chart of accounts explanations document is available on the IFS website, and it will help you determine the correct account numbers. Record the chart of account 3-digit code in the appropriate column. Record the amount. For deposits, record in the deposit amount column. For withdrawals or amounts paid by the trust, record in the expense check/debit amount column. The account balance column will update automatically to reflect the available balance in the bank or savings account. This balance should equal your reconciled bank statement balance at the end of each month. Expenses that have different categories lumped together, for example, credit card or loan payments, must be split into various expense categories and listed on separate lines. Loan payments must be split into principal and interest. Each credit card expense must be listed on a separate line. Expenses in the same category or chart of account number can be totaled and entered on one line, but different categories must be listed on separate lines. Let's look at some examples for splitting certain categories, starting with rental property. Rental property number 1, 123 Any Street. Enter all income and expenses on the separate rental register. Take the ending balance or net income for that property at the end of each month and enter this net income on the main register, but do not enter a chart of account number as shown. For the following months, take the balance column number or net income and subtract that number from the balance column number of the ending date of the previous month to get the net income for that month. Enter that month's net income balance on the main register as shown above. This will make the balance column on the main register equal the correct bank reconciled balance for that month. Credit card entries are always split into the various categories when posting to the deposit and expense register. The total of these entries will equal the actual credit card payment. Example, $325 credit card bill paid by the trust on 4/15/21. On 4/15/21, the description is supplies, the check number is 1501, the chart of account number is 665, and it's an expense of $75. You can also see lumped together on 4/15/21, description medical, same check 1501, chart of accounts 635, expense $215. Also on 4/15/21, description gasoline, check 1501, chart of accounts 605, expense $32. So to recap, 75 plus 215 plus 32 equals a $325 payment. Example, $325 credit card bill, only $100 paid, 4/15/21. As you can see on 4/15/21, supplies, medical, AP/credit card was paid on check 1801 with chart of accounts numbers 665 for supplies, 635 for medical, and 201 for credit card. You can also see $190 on deposit, as well as $75 and $215 on expense. To recap, 75 plus 215 minus 190 equals $100 paid. Note payments are split into principal and interest. Example, $825 mortgage paid by the trust on 7/15/21. As you can see in this example, $509.84 plus $315.16 equals an $825 payment. Asset sales or other investment sale with capital gains or losses. Post the original cost basis in the deposit column to reduce the asset account. The cost basis is the original cost of the asset when placed into the trust. Post any cost involved with the sale to the expense check/DB column. Post the gain or deposit column or loss and expense column to short-term or long-term. The total of these entries will equal the proceeds received. Example, $8,075 proceeds from an asset sale on 9/15/21. To recap, $9,008.81 minus $1,100 plus $3,015.16 minus $2,850 equals $8,075 proceeds. Again, it's important to emphasize how crucial it is that your beneficial trust financial data or deposit expense register is to be kept up to date on a monthly basis, so after receipt of the trust's December bank statement, a reconciliation can be completed in the first week of January, and then the completed data can be sent to IFS by January 20th. Thank you for your attention to this trust training video. In our next instructional video, we will be teaching you how to understand the chart of accounts, what are allowable trust expenses, what are disallowable trust expenses, and what is a demand note. Again, the information we've covered in this session was quite a lot, but you have taken another big step into the world of managing your Spendthrift Trust. It is another step that will help protect your assets and build generational wealth. Congratulations.